Hello, good morning and welcome to the week ahead for Monday the 5th of January and a happy new year to everybody. We'll be looking at what's going on this week in global markets. I'm joined by Axel, Rudolph.
Morning, Chris, and Happy New Year.
Happy New Year. How was your holiday?
It was nice, thank you very much.
Good. Now, it's an interesting start to the year because you've had Trump abducting the president of Venezuela from his bed, if all reports are to be believed. And you've got the FTSE 100 opening up briefly above 10,000 this morning. In fact, it touched it on Friday, the last trading session of last week, and the first one, of course, the first full one of 2026. So it's a bit of a risk-on start to the year overall, but certainly for stock markets.
Certainly, and I think we also saw some Asian markets hitting record highs this morning. So I believe it was the South Korean market, is
South
that
Korea,
correct?
Kospi, yeah,
Exactly.
just a new record high, and 52,000 on the Nikkei as well, I think, as well.
Yes.
Briefly.
So, I mean, if we start looking at the FTSE 100, for example, we can see on the chart that we're still in a very clear uptrend, and nothing's really changed since the end of December. You can see here that sort of towards the middle of December, we just traded sideways with very little volatility because it was the festive season. That's totally normal.
Yeah.
And now we continue on the back of what we did on Friday, on the 2nd of January, the first day of trading, where we went up and hit the psychological 10,000 mark.
Yeah, it was a very excitable session. I suppose when these low volume sessions you get around this time of year, and markets can move very quickly. In fact, with the US, you had an interesting session because a very strong start to the day for tech stocks, and then they reversed entirely. But the Dow seemed to take over in the afternoon session in the US. So actually things ended up fairly positively. I think as well, it means we got a positive Santa rally period as well for markets, which tends to be, I think, what's the word, positive or a strong indicator for the rest of the year, isn't it really?
It tends to be, yes, historically. And also the fact that we've had these, what shall I call them, geopolitical tensions in Venezuela, hasn't led to risk-off sentiment, which you could have expected, but it hasn't. And instead, markets are still looking bullish, and it looks as if this first week is going to be a positive one for equity markets.
We kind of picked up where we left off at the end of last year, didn't we? You had markets still looking very strong. Breadth was very good across US indices, so that's a good sign for what comes next. And volatility on the back foot. The VIX once again dropping as it finished off the year. And that's continued into the new year so far, hasn't it? I think what characterized the end of last year was worries about overvaluation. The infamous bubble word keeps cropping up from time to time. But the market still seems to be able to shrug those fears off after sort of a brief period of volatility, doesn't it?
It does. But having said that, if you look at the Nasdaq, it has underperformed in the last couple of weeks.
That's a good one, actually. Let's look at that to see on the chart, because you're right. It's still well off where we were at the end of October in terms of a record high. And that's a bit of an interesting sign after months and months of gains for tech stocks.
Yes, so as you can see here on this chart, we did break through a downtrend line that then led us higher, but we were sort of always struggling around the 25,600 area. And right now, we don't look as positive as we do, for example, on the Dow. As you can see here, the Dow is still heading higher because here the consolidation phase was just sort of trading sideways above the mid-December lows, and that's still very clearly an uptrend, whereas the Nasdaq 100 has done something similar, but is more in a range trading phase still at this point, if you look at the chart here.
That could be what we call rotation, though, isn't it? I think that would maybe people moving out of tech stocks, moving into other sectors of the market because they think, again, tech stocks look overvalued for whatever reason, or people worry they look overvalued. I think it's the thing you kind of see in the rearview mirror. So it's probably healthy for the broader market that it's not just a rally driven by the Nasdaq all the time. But certainly if you're trading the Nasdaq, it's particularly disappointing, as opposed to see it lagging behind other indices over the last, say, month or so. An interesting development.
Yes, I would totally agree with that. And the question now is, in January, are we going to see a rotation back into tech? Or are we going to see what we saw at the end of last year, as you say, more breadth and investors going into the companies which actually are not in tech and are sort of driving the US economy forward as well.
And we should talk about oil. We should do oil, I think, because that's the key mover on the macro front, the geopolitical front over the weekend. The abduction of the president of Venezuela meant that oil prices, well, it was expected that oil prices would come under pressure. If you looked at our weekend markets over the course of the last 2 days, they were actually higher. But as sort of full-on trading gets underway, once again, you've got a downward move for oil prices, which again continues where we left off at the end of 2025. And it's particularly interesting that the weakness in oil all the way through the last quarter of the year is a sort of theme that stayed with us. And the expectation is maybe a little bit premature that Venezuela's production will return to the market, that it will increase over time. I think there's a lot of months of work to be involved in that. But it seems to be the way the market is looking and thinking that this supply glut, if you like, and this somewhat weak demand is expected to continue. Is that correct?
That's exactly how the market sees it. As we can see, that the trend is still pointing downwards, and it has been pointing downwards since basically the highs we saw in June.
The summer with the Iran-Israel.
Exactly. So, you don't want to fight the trend, and the trend is still pointing down. And if I actually go onto a longer-term chart, if you look at the weekly chart, we can see that this downtrend has been in place since 2022 now. And, investors quite often ask now, oh, should I buy here because it's at lows? Yes, relatively speaking, we're in a good sort of support area here going back several years. But if we were to fall through the lows we saw back in May of this year, so we're talking below $55, we might easily slip towards $50 or even lower than that.
With the possibility that you get the occasional substantial rally along the way, I suppose. That's the risk, isn't it? Because it's been very much a one-way move. And particularly in December, you had oil going from, so US crude go from 60 to 55 in the space of 2 weeks or so, barely even 2 weeks, I think, and then a recovery. But the theme has been those brief recoveries, and then it continues to sell off. So the price continues to sort of dominate. The price actually continues to dominate on the bearish side, doesn't it, really?
Exactly, and these recoveries is quite often linked to investors thinking, oh, this might actually be the bottom now, we're trying to get back in again, or some news flow from a fundamental point of view, which points towards more demand being there. But the big story is basically there is just so much supply of oil that the price keeps going lower.
Sloshing around. And then on the flip side of that, you've got gold. Very solid start to the week, up 2.2% or so in early trading. Continue where, again, it seems to be the theme this morning, continue where we left off the end of last week, which is its recovery, because you had that volatility, shall I say, which again is volatility mostly is just things going down, and that's what you had with gold, in that sharp drop, probably accentuated by silver more than anything else. And then suddenly the recovery over the last sort of week or so.
I mean, as you say, it was mostly silver, which had a huge 11% drop in very, very low volume trading. And in Asia, basically what we saw is a lot of speculative buying just before that, because it was all over social media that the silver price had gone above $80 per troy ounce. And then suddenly you got this big reversal as we came back into the markets in Europe on that Monday. And you can see that big drop here on the chart, and as I said, silver price down 11%, but also affecting the gold price here, affecting the copper price and so forth. Having said all that, if you look at the trends, they're still bullish. So basically, as long as we stay above the late December low here on the 31st of December, the trend's your friend and still pointing higher. So I wouldn't be surprised if we make highs around $4,600 and are heading towards the psychological $5,000 mark perhaps later this year.
Exactly, and I suppose people look at it and think it can't go any higher. It's gone up a lot this year. Silver's up 150% over the past year. Gold's up heavily as well. Surely it can't go any higher. But is it, when you're trading it, how do you sort of disconnect those feelings from what you're seeing in terms of the price action? Because it's understandable. You look at something that's gone up a lot, especially in the last 2 or 3 months, and you think, well, it can't keep going up, I think is the way humans tend to look at these things, isn't it?
Yes, but that's why most people get it wrong, because there is a reason why it's going up, and that momentum is driving the price higher, and quite often it is based on fundamentals. And we know, for example, with silver, a lot of industrial production needs silver. All the electric vehicles, the solar panels, and all of that needs a lot of silver, and therefore the price will probably keep on rising. It's not just speculative buying, it's not just hedge funds buying, it's actual industry needing the metal in order to be able to produce the goods. So that demand is not going to go away anytime soon, I believe, and the price is reflecting that. That's why we went all the way up to a record high at $84 in December, and there is no reason for it not to go towards $100 perhaps later this year.
Should we talk about what's coming up this week in terms of actual calendar events? If we look at the week ahead for the next 5 days. Of course, despite being a slightly quieter start to the year for corporate news, not so much on the FTSE 100 this morning, we do have plenty on the economic front, don't we? So with the week ahead, if we're looking at that, which you should get in your inbox every Sunday evening if you're signed up, Monday starts off with the ISM manufacturing PMI in the US, which is always a very useful piece of data, I think, isn't it? It's one of those key numbers to look for every month.
Yes, it certainly is. And also later in the week, we've got the services PMI. So that will be a good start to the week to see what the data is saying. But that's not really the main focal point for this week. It'll be on Friday, the US non-farm payrolls. But before that, we also have the JOLTS numbers, the ADP employment change. So a lot of focus will be, in the US at least, on employment data. And whether the Fed sees further weakness in the employment data in the US and therefore might cut rates further in 2026. At the moment, we are expecting 1 to 2 cuts perhaps this year. Maybe that might go to 3. Nobody expects that at the moment, but it will really very much depend on the employment data as well, not just on inflation.
And of course, it's back to normal for payrolls because you've had 2 or 3 months of disruption because of the government shutdown at the end of last year, in the autumn of last year in the US. So it meant that payrolls for November were delayed. October's payrolls didn't happen. November's were delayed, in fact, to after the Fed meeting, and so their importance was arguably limited. But this is the first one that's back to normal, if you like, and that's expected to show a weakness in employment growth. So 12,000 jobs created versus 64,000 the month before. And the key number perhaps there is that the unemployment rate is going to rise as well, which is what I think we expected would be the case, and indeed would align, as you say, with the Fed looking for further weakness in the employment market to support its view that further cuts in interest rates are necessary.
So, of course, the Fed lowering interest rates has been driving equity markets higher than 2025, and that trend is likely to continue if we expect further rate cuts to be seen this year, which we do.
So we should talk about the dollar as we're waiting for these numbers this week with dollar index or dollar basket on the platform. You've seen the dollar bounce from those lows at the end of last year. And 2025 was a year of 2 halves, if I can use the cliche, for the dollar, because you had these huge losses in the first half of the year. And then just when it seemed that the bearishness wasn't going away, you did then have a very steady recovery, if you like, for the US dollar versus over the dollar basket, really, and look at euro dollar as well.
Yes, and we can see that here on euro dollar. I mean, clearly we've had these 2 phases, but what is interesting is that since November of last year, the dollar has actually been falling. And over the Christmas period, the festive season, it has been rising slightly. The question is that low volume short-term downtrend going to dominate now at the beginning of the year? Or are we going to see a continuation of the US dollar weakening going forward? And I expect that to be more the case than the dollar strengthening personally.
It's the question of where we see economic policy in the US settling, because it's a year when fiscal stimulus is expected to step up quite a bit, I think, through various tax cuts and other administration efforts, I think is the key thing to watch for. And you've got an environment where the Bank of England's cutting rates, the Fed is cutting rates, the ECB, though, still keen not to, and of course the Bank of Japan increasing interest rates. I hesitate to use the word hiking because they're doing it so slowly, but certainly increasing interest rates. And perhaps that's the other one to watch for in terms of dollar yen, that you've seen it, a very, very strong rally from 142 to 156 at the time of speaking, that shows no sign of reversing either. So that's an interesting dynamic on that front as well.
Yes, exactly. I mean, if you look at dollar yen, you can see that we've been rising quite steadily since April of this year, and are attacking the highs seen back at the beginning of last year. So here, dollar yen heading towards the 160 yen area. and still being in that trend. So the question then is the Bank of Japan going to intervene?
Yeah. As soon as it gets towards those 160 levels, the word comes out, doesn't it? Intervention. Which is the thing that drove volatility back in 2024 as well. So I think as with all these sort of key levels in markets, sort of 10,000 the FTSE, 160 on dollar yen, it's the big numbers that always attract attention, isn't it?
It certainly is. Round numbers we just feel comfortable with. We can remember those, and therefore markets tend to gravitate towards those. And as you just said, in July of 2024, we had these rumors of intervention. We even did see some intervention, and then we had the big decline in dollar yen. And we saw something similar at the beginning of last year. The question is, are we going to see the same thing happening again this year? Will we see dollar yen revert and head back down again?
Yes, the key thing. So we should talk as well about company events. We do have a few in the UK, particularly this week, because it's now Christmas trading season, Christmas trading update season, when everyone needs to get their updates in as quickly as possible. So you may get a flood of UK trading updates over the next 2 or 3 weeks. But the ones we have this week, on the week ahead, we've got Next coming up on the 6th of January, along with Sainsbury's, Tesco and Marks & Spencer, and of course Greggs on the 8th of January. So do keep an eye out for those. Of those, which ones would be most interesting for you, Axel, do you think, from a chart perspective?
My choice would probably be Next. Next has done really well over the last few years. As you can see on this weekly chart, we've been rising since 2022, I believe. And yes, short term, we are consolidating a bit, but the long-term uptrend is still very much intact. If I go into a daily chart, I would like to buy a breakout of this sort of flag pattern when it does occur. At the moment, we're just heading down again. But you can see here in December, we found some support close to the highs we saw back in June of last year. And I wouldn't be surprised that if we were to slide slightly further, it'll very much depend, obviously, on the trading statement, but I wouldn't be surprised if we were to see support there and then probably head back up again. So Next, for me, looks quite interesting from a medium to longer term perspective.
It's one of the stars of the index, really, and certainly from a retail perspective, it's doing very well. I suppose it's one to sort of talk about as a UK success story. But you also have, of course, Tesco, Sainsbury's. Key trading updates for these, because how important these Christmas trading updates are for retailers. Is an important trading period. It drives really a lot of sentiment around the sector for the rest of the year. So for the retailers, they are going to be the driver on the FTSE 100 and the FTSE 250 really for the next couple of weeks, I should think.
Yes, I mean, if you look at Tesco, it had a pretty good year in 2025. If I just zoom out here, you can see this nice uptrend. But basically, since November, it's been stalling. And you can see here it's just sort of trading around the support area. And the question is, after the trading statement, will we be able to hold in that support area on 430 pence or not? If not, we could see a slip further towards the 400 pence area. And maybe then we will head back up again. But yes, Tesco's not looking as interesting for me from a long-term buying perspective as Next is.
It certainly seems to have sorted out a lot of its fundamental problems, I think, as Tesco, still the largest UK supermarket. And the talk that we had years past of Aldi and Lidl really eating into their market dominance seems to have abated. Everyone seems to have found their level, if you like, in terms of market dominance within the sector. So those are the key things we're expecting this week in markets. A slightly busier start for the first full trading week of 2026. I would just flag, looking into next week, US earnings season is fast approaching. JP Morgan, the first up as ever, a report on the 13th of January. So I expect that to be the major theme beyond this week. And Axel, where do people sign up for the week ahead?
Very good point, Chris. So basically, go on this URL up here on the IG.com website, and you can sign up to this for free at the top of the page, basically. As you can see here, just put your name and your email, and we will send you the week ahead every Sunday evening at 6 p.m. UK time.
We should talk about your trade of the week, the first one for 2026.
Well, my trade of the week is basically to go long the Dow Jones Industrial Average. Why? Because we discussed the rotation out of tech stocks at the end of last year. And I don't think that will change anytime soon. And the chart also looks very healthy. You've had a very nice uptrend all of 2025. and we are very close to breaking out of a sideways trading pattern towards the upside, in which case I wouldn't be surprised if the Dow were to head towards the psychological 50,000 mark. So round numbers, as I said before, do tend to act as a magnet for financial markets, and the Dow is looking really, really healthy to me. Let me just have a quick look at my chart. So what we can see here is that the descent, the very short-term descent at the beginning of the year, on the 2nd of January, basically held at the mid-December lows. You can see that here, and then we bounced back very nicely. So as I said, this is an uptrend. I mean, if you scroll back to 2025, you can see clearly from April onwards, it was a very clear uptrend. And that momentum is more likely to continue than not. And therefore, once we break above the all-time record high we saw on the 12th of December, around 48,880 or so, we should, in my opinion, head towards the next big round number, which is 50,000.
Okay, so expecting another good start to the year for the Dow. What about our stop loss for this trade?
Very good point, Chris. I mean, stop losses are very, very important. That's what we always do with Trade of the Week. So we not only just risk 2% of capital per trade, but we also make sure that we define that risk with regards to our stop loss. So what we always do is look at our entry level, see where our stop loss is, and then that will decide how big a bet we will put on. In this case, my stop loss would be not just the low from the 2nd of January, because we've got a slightly lower low on the 19th of December. So I would place it just below here at 47,785, for example. So that would be my stop loss. And my upside target, because what you always try to aim for is to get a bigger reward on average than a loss. And therefore, what I would like to look at is probably something like, 49,950, just below the psychological 50,000 area. And this might not be hit for several weeks or even months. But it's a long-term trade at the beginning of the year, and I believe the reward to risk ratio is quite positive on that one.
And you had a good end to the last year with Trade of the Week, didn't you?
Yes, I did. We did.
Well, we did.
We did them together.
It's mostly you, I should have to say, really. It's mostly your Trade of the Week. So
yes, we got another double-digit gain, over 20% gain, risking just 2% of capital on every trade, and or bet, I should say. And it's all about that. Basically, you need to manage your risk, and you need to make sure that on average, you tend to be hopefully right more often than wrong, and that your reward is on average bigger than your risk. And that's why you place a stop loss quite tightly, usually to where you are entering your market. But having said that, I mean, last year I was actually wrong more often than right. I think I was only right about 47% of the time. And yet we still made 20%.
Still made money even
the
with
year
that.
before, I think we were just right about 50% of the time. And yet we made over 31% return. So you can get good double-digit returns per year, risking just 2% of capital per trade if you manage your risk correctly. And this is what this is all about, basically, Trade of the Week. Not just trading ideas, but educating investors and traders how to manage your risk, how to get the odds on your side, and then how to also let your profits run. A lot of people cash in their profits far too early.
Yeah. Thank you, Axel. And that sounds like a good start to the year for Trade of the Week. Thank you, everybody, for joining us for the week ahead. Have a good week. Don't forget to like and subscribe, and we will see you again next Monday.